I'm Reed, I'm Arshad, just an average dude. I've made tons of money mistakes in my Arshamau, and now I want to share everything I've learned to help you take control of your finances and your life. Alright, peace. Let's talk about something absolutely wild that is happening right now in the world of high finance. Something that might seem far removed from our daily lives, but could directly impact the value of our investments, especially if you're holding gold. We're talking about a full-blown, no-holds, barred internal conflict at the Federal Reserve, a battle for the very soul of monetary policy that hasn't been this intense in centuries years. And honestly, it's a total mess. So here's the setup. Trump, who's famously obsessed with lowering interest rates to pump up the economy, pulled out all the stops to install his guy, Kevin Warsh, as the new Fed chair for the first time. In centuries years, a Fed chair's inauguration ceremony was held at the White House. Trump was personally there. A Supreme Court justice administered the oath. The Treasury Secretary was present. He practically wanted the whole world to know, this is my guy. Rate cut season is coming. He handpicked Warsh because he believes Warsh is the guy who will bring those rates down. But here's where it gets absolutely insane. Before Warsh's butt even warmed the chair, literally on the same day as his White House inauguration, one of his own colleagues, Fed Governor Christopher Waller, dropped a bombshell at a forum in Frankfurt right in front of a global audience of investors. Waller said, and I quote, "You cannot look at these data and seriously suggest we can cut rates in September." He even added, inflation is going in the wrong direction. Think about it. One guy is popping champagne at the White House celebrating the dawn of rate cuts, while another Fed official is basically throwing a hand grenade at the idea in a major financial capital. It is a level of public disunity that is almost unprecedented. Right now, gold is stuck around 17,200, not really moving up or down. It's not because the market lacks direction. It's because the Federal Reserve is embroiled in its most ferocious internal battle in nearly 4 decades. And in this video, I'm going to break down exactly what is happening, why gold is pinned at this price, why a set of crucial data coming out this Thursday could definitively push gold to 17,700 or smash it down to 17,700. And this is the juicy part, specific Baffin's data difference that industry insiders are buzzing about. But most people probably don't even know exists. This Baffin's is the real powder keg. Okay, back to Waller's comments. What exactly did he say? He argued that the Fed should remove its easing bias from its policy statement. In plain English, he's saying, stop assuming the next step has to be a rate cut. The probability of a hike or a cut should be equal. And again, he explicitly stated, inflation is going in the wrong direction. Now, Waller isn't some fringe figure. He is one of the most influential governors on the Fed board. Historically, he has even been considered a bit of a dove. Back in late 1990, he supported 60 basis points of rate cuts. So when even a dove like Waller suddenly turns hawkish, what kind of room do you think Warsh is walking into when he enters that first FOMC meeting? He's not walking into a room full of colleagues eager to cut rates with him. He's walking into a room full of people sharpening their knives, ready to hike rates. This is a political minefield both internally and externally. The last FOMC meeting saw 4 dissenting votes, with opinions sharply divided, some wanting a more hawkish stance, others more dovish. This was the most fractured vote since Joe by Josharar, highlighting the deep philosophical chasm within the Fed. And then there is Jerome Powell. Powell, the previous chair, announced he's staying on as a Fed governor, not resigning. This January Fed veteran, the man Warsh just replaced, will literally be sitting right next to him. Powell famously said, there can only be one chairman of the Federal Reserve, confirming that once Warsh is sworn in, he is the guy. But Powell also added another very significant caveat. I am waiting for that investigation to be completely over. He is referring to the criminal investigation initiated by Trump against him. This means Powell will remain on the board, and his vote could be a critical swing vote at crucial moments, a constant presence that Warsh can't ignore. CNBC's headline put it bluntly, Warsh walks into a family civil war. The latest data from CME FedWatch, which tracks market expectations for Fed rate moves, shows a near Baffin's probability of a June rate cut, and less than a Baffin's assured chance of any cuts this year. So Trump sent his guy to cut rates, and he's walked into a room where everyone is discussing raising rates. That, my friends, is the biggest contradiction in the current gold market, and it is the real meaning behind that 17,200 price. But do you think that's the whole story? Far from it. To truly understand where gold is headed, you have to understand the philosophy inside Warsh's head. Many analyses stop at he's Trump's guy, which is far too superficial. Warsh comes from a Wall Street investment banking background, Morgan Stanley. He was a White House economic advisor in his early centuries and became the youngest Fed governor in history at centuries. He lived through the entire 2008 financial crisis, sitting at the decision-making table. He is not some academic from an ivory tower. He is a street fighter who has seen the market's brutal realities. But more critically, it is his core belief system. Wash has long championed the idea that low interest rates and high economic growth are not mutually exclusive. He believes that through technological advancements, increased productivity, and easing supply-side constraints, inflation can be absorbed even in a low-interest rate environment, leading to sustained economic prosperity. Does that theory sound familiar? It should. It is eerily similar to Alan Greenspan's New Economy Golden Era theory from the 1998 So, when Wash said at his inauguration that he intends to build a reform-oriented Fed, one that learns from past successes and failures, and breaks free from rigid traditional frameworks and models, industry insiders immediately thought of Greenspan. It is not just because both were sworn in at the White House, or because both faced rising oil prices and inflation pressures upon taking office. It is because their fundamental economic beliefs are strikingly similar. Greenspan back then believed information technology would usher in a productivity revolution, even using large supercomputers for economic modeling. He was a direct beneficiary of the burgeoning information age. Similarly, Wash explicitly stated in his confirmation hearing that he believes AI's transformative potential for productivity is akin to another industrial revolution. Their political circumstances were even similar. Reagan needed a successor who would maintain an anti-inflation stance while also being willing to deregulate financial markets. Greenspan was that man. Today, Trump desperately needs someone who will cut rates to stimulate the economy and won't openly challenge the White House. Wash is that man. Greenspan in his early tenure had to prove to the market that he wasn't a White House puppet. Wash faces the same challenge today. His Wushawu and Sishawu Senate confirmation vote was the lowest for a Fed chair in history. Senator Elizabeth Warren even directly called him Trump's puppet. Their initial situations are almost a carbon copy. And what path did Greenspan eventually take in the mid-2? Late 1998, the U.S. economy was robust, fueled by the dot-com boom. Greenspan famously warned of irrational exuberance in 1998, but the market largely ignored him and continued to soar. Meanwhile, oil prices climbed and inflation concerns grew. In 1998alone, he hiked rates 6 times, from 4.75% to 6.5%. Then, by late 2010, consumer spending and manufacturing orders stalled, the dot-com bubble burst, and then came Sheaf and Jojo. The Fed, under Greenspan, dramatically cut rates from 5.25% to 5% between January 2010 and June 2010. With multiple large rate cuts, it wasn't until June 2010 that they started hiking again, and it was precisely those years of ultra-low rates that fueled the massive surge of money into real estate across America, laying the groundwork for the 2010 subprime mortgage crisis. After his retirement, Greenspan openly admitted in congressional testimony that his lifelong belief in financial institutions' self-regulation and the perfect self-correction of free markets had flaws, and that the scale of the financial crisis shocked and defied belief. Wash, at his inauguration, spoke of learning from both successes and failures. Greenspan's success was breaking from traditional frameworks and accurately predicting technology's miracle in productivity. His failure was the long period of low interest rates, combined with an over-reliance on market self-regulation, which led to 2 massive asset bubbles. There is a saying on Wall Street, the Greenspan put. It means that every time the market stumbled, Greenspan would step in to provide a safety net. This psychological assurance significantly fueled speculation and excessive risk. Can Wash avoid repeating this pattern? Or will he, under political pressure from the White House and the market's insatiable greed, gradually slide into another unpredictable macroeconomic bubble? The answer to that question is literally embedded in the price of gold. Greenspan's new economy faith led to the dot-com bubble. What will Wash's economy faith unleash? Gold's current pricing is essentially trying to answer that very question. Okay, now let's bring this down to the actual charts. And what is happening on the ground? Gold is currently trading between 4,591美元 and 4,580美元 from its all-time high of 5,595美元on January 29th. It has pulled back about 18%. In early May, it briefly dropped to 4,560美元, a 5-week low, but it hasn't crashed. Instead, it has been oscillating within a wide range of 4,300美元 to 4,840美元for over a month. On the technical front, the20-day moving average around 4,300美元acts as strong support, while the 50-day moving average at 4,740美元forms dynamic resistance. Last Friday, gold closed at 4,520美元. This Monday, after the Asian session opened, it jumped into the 4,560-4,580 range, landing right in the middle of this trading box, neither up nor down. Bulls and bears are locked in a stalemate, with both sides armed and unable to deliver a knockout blow. Why is it stuck here? Because both the bulls and the bears have solid ammunition. The bulls point to strong inflows. In April, global gold ETFs saw $2 billion in net inflows, recovering from the record $1 billion outflow in March. Asian money especially has been consistently buying on every dip, showing incredible conviction. By the end of April, total global gold ETF holdings reached 6,000 tons, just shy of the all-time record of 6,000 tons, set on February 20th. The largest U.S. gold ETF also saw $1 billion in net inflows in April, narrowing its year-to-date outflow to $1 billion. State Street, in its May report, explicitly stated that a $1 upward level would hold even in a bear market scenario, that is serious money betting on gold. On the bear side, the 10-year U.S. Treasury yield remains elevated, hovering around its highest level since the dollar index, while off its Nantu highs is still strong around Joshua. And then there is inflation. April CPI surged to ba, the highest since mid-Arsen CME's FedWatch tool, now shows a probability of no rate cuts this year. Furthermore, COMEX managed money net long positions declined by in April, and retail positions are also being reduced. Speculators in the futures market are running for the exits. So on one hand, you have massive ETF funds buying the dips. On the other, you have speculative futures traders bailing out. This kind of divergence historically signals one thing: the market is brewing a directional breakout. The question is, in which direction? The answer isn't in technical charts. It is in this Thursday's data, and in that elusive in Wash's head. A stalemate is never the end. It is just the silence before the storm. That isn't just a price. It is a ballot. You're voting with your hard-earned money, betting on whether Wash or Waller will ultimately win this internal Fed war. Now, I'm going to tell you something that insiders know, but outsiders almost certainly haven't noticed. This could be the most critical variable for gold's movement over the next 3 to 6 months. Yet almost no mainstream media in China has discussed it seriously. On April emails, Wash said something seemingly innocuous but incredibly profound during his Senate Banking Committee hearing. He stated that he does not entirely trust the Fed's own inflation metrics. What does this mean? The Fed's official inflation gauge is core PCE. Its latest reading is but Wash prefers to use another metric, the Dallas Fed's trimmed mean PCE. This indicator simply trims away the items with the biggest price increases and biggest price decreases each month, focusing only on the middle range. This filters out short-term noise and gives a more stable underlying inflation picture. The trimmed mean PCE's current reading is Sen. The gap between Sen and Sen is 0.2 percentage points. You might think, what is the big deal about T? This T is the dividing line between cutting rates and not cutting rates. If the Fed is looking at the core PCE, inflation is still 1 full percentage point above target, making rate cuts unthinkable. But if they adopt the Sen trimmed mean PCE, inflation is very close to the target, opening the door for rate cuts. What Wash wants to do, essentially, is change the thermometer. If you have a fever, and you switch to a thermometer that reads lower, you appear less sick. But here is the crucial part. This isn't just playing games. The trimmed mean PCE is widely accepted in academia.